Capital Management's quarterly update webinar series titled CIO's Corner with our Chief Investment Officer, Chris Gauthier. I'm Amanda Sylvia, and I'm the Client Service Associate for Stonehearth, and I'm so happy to be assisting Chris today. I would like to start off with a few housekeeping items. So on your GoToMeeting taskbar, you should see a section specific to questions. We hope you feel comfortable to use this section to submit any questions you may have throughout the course of the webinar. I will be monitoring those as we go along, and will ask Chris to answer as many as he can at the end of the webinar. And if we do just happen to run a little bit low on time and do not get to your question, Chris or myself will reach out to you directly at the end of the webinar to make sure that we do get your question answered. I am really excited to introduce our speaker, Chris Gauthier, Stonehearth's Chief Investment Officer. He brings more than 16 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda, for that wonderful introduction, and good afternoon, everyone. Thank you for joining me today. Going to be a little bit different feel this quarter, given the timing of the presentation. We're doing this a little bit late to the summer. We usually look at quarter-to-quarter data, so we look at April to June in this presentation, but actually we're going to be looking from May to July because we have the updated data. It's due to vacation, a little bout of COVID, so we're doing this a little bit later, but it gives us access to more updated data, so it should be good. So anywhere we see historical data, it's going to be as of July 31st, 2022. So with that, let's jump right in. And then as always, I'm going to go over what we're going to cover today. We're going to review historical performance. You know, we saw a nice reversal in July. If we did this in June, we'd be telling a very different story, but we had that really good July. You know, so big, nice bounce from the recent weakness in financial markets, but really not enough to change that poor returns we have seen so far in 2022. We'll take a look at the current investment environment, you know, as we saw an increase in risk across the board, which is really indicating that excess risk is not warranted in client portfolios. But there are some bright spots, particularly in the macro data we're looking at, so it's not all bad out there. We'll look at how we're positioning client portfolios in this environment. And like Amanda mentioned, if we have any questions out there, we should have a few minutes left to answer those. So like I always like to do, I just want to start with our investment philosophy. I wish more firms would do this because, again, this gives you a nice framework for our discussion and really helps shed light on our thought process and really leads to a much fuller understanding of the conclusions we come to. And if your firm does not have an investment philosophy, there's something wrong because that's the investment process should be built on. And over here at Stonehearth Capital, you know, we believe in mean reversion. Trees don't grow to the sky. Things oscillate around the mean. People who were on the call before know that we really have a prime focus on valuation. Price matters to long-term returns. We do believe in core factors, characteristics of individual investments that drive long-term excess returns above what you can get from market cap weighted indices. Still believe in diversification as the only free lunch, and 2022 is a great example of how that, you know, it may go away for short-term periods here and there, but over the long term, it still is the only free lunch. You know, we believe risk is not stationary. You know, fluctuates throughout the market cycle and must be taken into account. So with that framework, let's start, as we always do, with the historical performance of asset classes. So like we mentioned at the beginning of the presentation, we're doing May to July. I know usually we do April to June in the Q2 presentation, but since we had access to the updated data and the timing of the presentation, we thought we'd give you the most up-to-date data. As a reminder, what we're looking here is multiple asset classes, and we've color-coded them to make it a little bit easier to see. So anytime you see purple, think fixed income, bonds, high yield, treasuries. Anytime you see that light blue, we're looking at U.S. equity. Could be small cap, could be large cap, but definitely U.S. focused equity. You see green, we're thinking international, overseas. Think Europe, England, France, over the emerging markets, China. And then anything else that doesn't fit into those categories, they're in yellow, and we call them alternatives. That's kind of what we're looking at here. And you can see in the past 3 months, ending July 2022, really the U.S. dollar led the way. And no surprise there as the Fed kept hiking rates. We saw a 75 basis point hike just recently. That's driving the dollar up over the past 3 months. And we really did see the riskier parts of the bond and equity markets not far behind. So you see corporate bonds at 2.5%, small cap, which tend to be riskier than the large cap, up 2.5% over the past 3 months. U.S. lead and equity land, as we saw negative returns, and again, in international, that's that green, from overseas markets, as record heat waves and energy disruptions from Russia gave investors pause about investing overseas. Inflation, rising rate trades did not work. As you see it back on the right-hand side, precious metals, commodities, floating rate really led to the downside as investors priced in an expected dovish Fed pivot. I'm sure you heard about that. We're not sure they got this one right. Maybe right in the short term. I think they may be wrong in the long term. And we'll see how we came to that conclusion when we take a look at the current environment a little bit later on in the presentation. Bucking the commodity trend, oil managed to eke out a small gain in the past 3 months, but as we'll see, it really was front-end loaded, as oil definitely has been weak lately. And even now, when we look at it just today, I was looking at oil today, it's an 80 handle on it. And I'm actually starting to see gas stations with a 3 in front of it, which makes me very excited. I'd love to see it too. I'm not sure we're going to get there, but at least we're seeing some good progress. And we're seeing that in the inflation numbers that we just saw, with energy coming down a little bit. So it's a little bit bigger difference when you extend the time period over to a year. You can see oil on the left-hand side up over 50%. It's far away the leader, but it's really living off its prior glory, like we talked about. Oil in general helped boost commodity prices. You see that up almost 30%. Still see the dollar, doing very well as the rising rates help that. Other than that, not a lot to like over the past years. You can see from all those negative returns. Every single other remaining asset class are in negative territory, led by international and long-term treasuries at the bottom end. Rising rate and inflation hedges, unlike July, really provided the most downside protection. You can see that in the floating rate, only down 3%. Doesn't seem like great being down 3%, but if your other options are down 5%, 9%, 15%, not bad only being down 3%. Saw some protection in short-term treasuries, and gold provided some nice hedges there too, only down 3%. On the U.S. equity market, it was definitely risk off, as big tech, represented by that NASDAQ down almost 13%, and small caps down 6.5%, trailed the less volatile large cap indices. And you look at the S&P only down under 5%, and Dow Jones, which is even less volatile, only down 4%. So again, looking past year, really definitely a risk off type of environment. For those of you who are clients who have joined us in previous calls, we view the equity markets through factors. Right? Think about value, things that trade cheap on fundamentals, quality, good, strong balance sheets, strong management, consistent earnings, yield, returning cash to shareholders, size, a little bit smaller in the marketplace, and momentum, good price returns over the short term. These are all what we call characteristics or factors of underlying stocks that make up the market. So you can slice and dice the equity market into these characteristics. And these characteristics tend to outperform the market cap indices over the long term. So the chart we're looking at here is from our friends at State Street. It shows all these factors compared to the MSCI USA index, which is a broad-based U.S. equity index. So again, we're looking at relative returns, not absolute. So when we look over here at the value, it doesn't mean that on the prior month it lost 3.5%. It was just, it performed less than the market by 3.5% to 4%. So it's relative returns. And we look at July, which is all in that gold there, you can really see a risk-on rally drove a sharp reversal in the factor performance. You can see that nothing really outperformed, but the best factors were quality, size, which hasn't been how it's been 2022. Really had yield, min-vol, and value underperforming in the month. But when we take a little bit longer term view and we look at that blue line, which is that year to date, we can see that those things underperformed in July are still outperforming in the long term. So value still outperforming the broad-based U.S. equity market by almost 3%, dividend yield by almost 9%, and then fall by 6%. So again, we still like those. Short-term levels here and there, we still think there's a lot of value in dividend yield, min-vol, and value, as you see in the later part of the presentation. So before we kind of look in the investment environment, I wanted to show you this. So in previous presentations, usually we have a chart here looking at equity drawdowns or drawdowns of the 60-40 portfolio, but really given the unprecedented massive move to the downside in bonds. And it really has been unprecedented. And you hear a lot about it in the press, people, and see it in their portfolios, because what they're really used to, you look at the bond market, is pretty stable returns, but not that many drawdowns, right? 7, 9, this is intra-year, so coming back, everyone was down 2, it ended up 33, down 7, it ended up only down 3. And look all the way over the right, putting what the movement historical context, we haven't seen anything like this, since the Great Depression, which isn't even on the chart here. We're down about 8% right now, and we were down 13 at the lows of the bond-based bond market. So sometimes it is different, and when you're sitting out there and you feel like it's different in the bond market, it is, And again, it's just this big experiment by the Fed out there, and we haven't seen this throughout history, so we don't know how, and we see how it's playing out in the bond market, these dislocations. So again, it is different. It is negative. We think a lot of it is priced in, that big downward move. So there is some more opportunity in bonds as we move out, and we'll show that in the presentation. But I just wanted to give you kind of where we are in the bond market and just how unprecedented these moves have been. So we'll move on to the current environment, and we'll start looking at COVID. I really hope at some point I can stop talking about COVID. I've had personal experience with COVID just recently. My wife had it. And then we had a little break, and then the rest of my family got it. And like this, we're seeing increases, right? That's that blue line. That's the bad part of COVID. But there is good parts. We see little movement in fatalities, which is this gray line or brown line down here. So again, more people are getting it, the impact is less. That's good. Good sign that the vaccinations and changing behavior is helping. Moving to the right-hand side of the chart, you can see the effects of the above. Next on the left-hand side, the real-time economic data from JP Morgan. So I use their credit card data. Are people staying in hotels? Are they going out to dinner? How much traveling they're doing by the TSA? And you can really see that we're almost back to pre-COVID levels. So even though we have a rise in cases, the impact is being less on the economy as we learn to live with COVID. And we can see that on the fatality side, and the impact is much less. So again, good progress on the COVID side. Still need to see more. And it's having a less and less impact on the true economy right now. So next chart, I'm sure you're hearing a lot of talk about recessions, and are we in one, are we not in one, 2 quarters of negative growth. Well, technically, yes, we did have 2 quarters of negative growth. You can see that on the right-hand side here. This is the blue line right here. So we see that we did have 2. If you use this definition, then yes, we are in one. But NBER, which is who calls all the recessions throughout prior history, they're the official word, is not ready to declare one yet. And I still think it's funny that all these talking heads go on there and say, of course we're in a recession because NBER uses this. Well, they don't use this, and they've said it, and they have it on their website. They use multiple data points, including employment, which we're going to show how hot that is right now. So again, tough to see a recession in the employment market. GDI, which is gross domestic income, which is the other side of GDP. Which is still positive. Consumer behavior, again, we saw in the real-time data, they're still spending. So putting all that together, the NBER says we're not there yet. But you will hear about this negative quarter-over-quarter contraction, and we did see it for 2, but it's not the definition of a recession. But we're getting closer, as we'll see. Turning to be the most important data point chart, I could just do a presentation just on this chart alone. Markets. It's influencing almost everything we see out there. And of course, it's the Fed. And what's the Fed going to do? So looking here is going out through history is the Fed funds rate. That's this brown line going out here. And you can see that right now we're about 2.38. Again, the target, don't exact. So it's up to 225 to 250. So with that equals a 238 raise. They just had a 75 basis point raise. No surprises there. The real big difference comes when we start thinking about what the Fed is telling us they're going to do and the market thinks they're going to do. When we look at the market thinks they're going to do, we call market expectations. That's that green line. We look at the Fed, the blue line, and you can see the big difference in expectations. And this really did change in July. There's really this dislocation between Fed and investors. As Fed maintained its onward and upward bias, what we see here, the market really began to price this so-called dovish pivot, and really drilling down onto that divergence. You can see it right here. Looking at that right end of the chart, you can see where the divergence really begins. This is the market going down here. I think this is where rates are going, and this is what the Fed says they're going to do. So why wouldn't you think that the Fed's going to do this if they said they're going to do this? Well, it's both the economic data. You think there's a Fed dovish pivot. You're looking at that GDP 2 negative quarters in a row, and you're saying, well, the Fed has to change. We're not sure that's the case, and we'll show that in the dual mandate later. But again, on the left-hand side, again, you can just see in July, which really drove that performance, was this change in this dovish pivot. So the market's not agreeing with what the Fed says. And to me, it doesn't really make a lot of sense. I really find it tough to find anything in the evidence and this data that says the Fed's going to be dovish. And they've said so much in their markets, but also the data says it. So really a $100,000 question is still, what is the terminal rate? Where does the Fed stop raising? And when do we get there? So again, when we think about the Fed, and this is the support case for the Fed onward and upward and the rates rising, is they have a dual mandate. I think you've heard about it, right? Their dual mandate is stable prices. They have said, we define stable prices as an average inflation rate, not a targeted inflation rate of 2%. Well, even with the lowest reading we had, it was still at 8%. So a long way to go. And you can see the expectations there by the market are a higher inflation. Again, if we have these expectations of inflation up at 5 and 6%, and we need to get to a 2% average, then yes, rates need to go higher. The Fed has to account for this because it's part of their mandate. They also have the other part of their mandate, full employment, whatever that means. They really haven't defined that, but to me it means they need a healthy labor market. And we look over here on the right-hand side, you can see the number of job openings, per unemployed person, good. So that's usually good for the market. Total unemployment heading down, that's good. Job openings up. Good. So you have higher prices than you want, not stable. You have a better employment picture. Dual mandate says, I keep raising rates until I hurt the employment market. So they have room to run here, and they still going to go. So again, we can talk about all the other economic data. When we look at the Fed's dual mandate, stable prices, full employment, they have a lot of room to raise rates here. Now, it doesn't mean they're not going to make a mistake and go too far, but I still think, onward and up here with their dual mandates, it's really tough to see a dovish pivot in the card for this data. So with that dual mandate in mind, let's take a closer look at the inflation and employment market. And we're first going to look at inflation. And the first thing to know about this is as of July, so we know we had a recent print that was weaker than expected. Well, weaker than expected means that it's not 9%, it's 8.7. And then if we actually look at core came in a little bit hotter than expected, which is what the Fed looks at. So again, we can talk about how it's a little bit lower, it's still very elevated. And we can see that here from the CPI, right? This is the CPI, this blue line, up at 9%. Core, what the Fed really looks at, and that's just taking out food and energy, so I think it's less volatile, still very high, 6%. And what's even more concerning, if you're worried about inflation, is its producer prices. And this is the beginning of the production cycle, and it's up at 11. So if you think that the beginning is up at 11, this would be catching up soon. So again, we may not see the top in inflation, but it definitely feels like we're at least very close to that. So again, I think lower inflation does not mean low inflation, right? Still elevated across the board. So we're still a long way from 2%. If you think core at like 6%. So again, long way from 2. Even if we get a decline, it may not be enough to bring inflation to target. And when we look at the makeup of the data, we can see where that is the case. So what we're looking at now is looking at that CPI and what makes up that number, right? What makes up consumer price index? Because that's all it is. They're just measuring the prices of basket of goods. And you can see they use energy, vehicles, food at home, other, which grabs everything, restaurants, shelter. And the first thing you know here is that we have this transitory and sticky. So that's really how we're breaking this out. So transitory, you can think about, this is the low-hanging fruit, energy. You can adjust these prices fairly quickly by raising and lowering rates. And you can see that even if you did the best job possible and worked all that transitory down to 0, sticky pieces are still a little bit above 4. We look at shelter. Think about houses, right? Houses don't fluctuate that much. They go up, they go down. They take a long-term time to adjust. Restaurants, once they raise prices, they can get you to pay $9 for a hamburger. They're not going to be lowering prices even if their input costs come down. They're going to keep it at 9% until people revolt. It's a long time for that to come down. Food at home, same thing. If they already can charge you $3 for a loaf of bread, I'm not going to lower it just because my input costs come down. So again, that sticky part means that inflation may be here for a while, and you're going to hear this a lot from us, Stonehearth, if you talk to us. Lower inflation does not mean low inflation. So we could be here for a while, which gives credence to the fact that the Fed needs to keep raising rates. The other side of that dual mandate is the employment market, and gives them the ability to raise rates, because when we look at the labor market, we don't see any signs of trouble. It's no signs of recession. It's on fire. And we look at this red line, that's the unemployment rate, almost at record lows, 3.5%. So again, if you want a job, there's one out there for you. And the people within the workforce is rising. Again, we need to see it get back up to like 64, where it was pre-COVID. But again, it's heading in the right direction. Then we said good earnings. And again, looking at the bottom chart here, you can see where inflation takes such a huge bite out of the economy, why the Fed is so concerned with it, and why they're going to keep raising rates. When you look at what people are earning on a nominal basis, again, this is just what you make in your take-home check, it's up 6%. Very healthy, very good. But when you have inflation up at 8% and things you're buying with that paycheck are increasing, it doesn't look so good. You're actually losing money when you take into account inflation. You can see where the Fed is going after inflation with such gusto. Then we look at the labor market, just kind of looks at what happened, what's going to happen in the future. And we look at that, I mean, it's just amazing to me. We look at the left, ratio of job openings to job seekers, almost at record highs. Job quits, almost at record highs too, right? You don't quit your job if there's a poor economy out there or a poor labor market. You just don't. You quit your job when you're either find another job or confident that you will be able to find another job. And then the bottom right-hand side, you see layoffs. I get it. You hear talking the earnings calls, we're not going to be hiring as much. We may be having layoffs, but it hasn't translated into the data. We're still at record low layoffs. Even that comes up a little bit, we're still at record low. So looking at the prices, Fed needs to get those under control, needs to raise rates. What would stop them? Well, in the dual mandate, if the job market was hurting. And by all measures, it is not hurting at all. So we think it's onward and up for the rates based on the dual mandate and the data. And we also see, in the economic data, signs of growth. What we're looking here is the services and manufacturing PMI survey data really attempt to glean insight to future economic activity. And like the employment market, no signs of recession. Anything above 50 indicates an economy that is expanding. And basically, these are survey data, so they're just asking companies, are things getting better, staying the same, or getting worse? And if more people and more indicators are getting better, it's above 50, you're in expansion. So looking at this data, it's tough to see a recession in the cards here. There's full-on expansion. Housing market also providing a good economic backdrop for economic activity. Look down here, the home prices on the bottom, onward and upward, nothing wrong with the housing market here. Maybe if you're trying to buy your first house, you may not be too happy. But for those of us who have houses or maybe selling them at some point, this is good to see houses up. And it's also good if you already own your own house, even if you have a mortgage. We see some housing starts coming down a little bit, and that had a lot to do with this recent rate rise in the 30-year mortgage as the Fed raises rates. And you can see that coming down, it just fell below 5. To us here at Stonehearth, the most important data point for the housing market is these supply, right? So throughout history, the biggest driver of prices, housing starts, has been, is there enough supply to meet demand? And we go through the historical average, you can see that on average is, 3.9, almost 4 homes per month supply. We look now, it's at 2.9. So again, nice recovery here, still a long way to go. So we think until we get into that a better supply-demand balance, that we're going to see some positive economic influence from the housing market. So that's kind of what the economy is telling us about what's going on in the marketplaces. So let's take a look at valuation, starting with the equity market. And we'll start, as we always do, with value, because what you pay for something has the largest impact on long-term returns. And we're looking at forward PE by that gray line, not as expensive as the recent past. You can see that up there, 2020. Up here, really expensive marketplace. So it's not as expensive. July's rise in prices weakened the valuation picture as it was driven by multiple expansion, which can be seen in the forward PE. You can see that right here. You're at 17.5 times. A little bit cheaper before, a little bit above average. So again, tough to say that the market is cheap when it's trading at above its 25-year average, even if it's not at recent levels we've seen. And then we can break that out to other valuation metrics. We use the CAPE, the Shiller's PE, which takes a longer 10-year view of the same data we're looking at here. Again, expensive, 31 times compared to its history of 28. Dividend yield, again, how much cash is returning at lower than it has throughout history. Price to book, the assets on the balance sheet, still elevated, cash flow elevated. So again, really telling you a picture that you may not be at these extreme overvalued levels, but really not cheap enough that has historically pointed to a return of a bull market. So a lot more work to do on the valuation picture. So again, in aggregate, the market does look expensive, but there are pockets that have better valuation support than the overall U.S. equity market. So again, we started off this presentation talking about factors, right? We break those off into valuation, size, volatility, yield, and the such. So again, doing that in the U.S. equity market, you get a little bit different picture from a valuation perspective. You can see what we're looking at here on the left-hand side, things that are inexpensive compared to where they've been throughout history, and on the right-hand side, more expensive than where they've been throughout history. So just looking at it becomes very clear where investors should be tilting their portfolio exposures to. You want to be on the left-hand side, tilted more towards momentum, dividend yield, volatility, and definitely a big slunk of valuation. So good valuation support in certain parts of the market, but still overvalued in aggregate. So we're just kind of wrapping up Q2 earnings season. We have about 86% of the companies have already reported. So overall, better than feared. We saw about 55% beat expectations, lower than we've seen in the past. But what really struck out to me was the guidance, and that's what we're looking at here. Is we're looking at earnings revisions. So again, this is like looking forward. Analysts raising their estimates based on earnings or lowering their estimates on earnings. You can see on the right-hand side, S&P's in blue, EFR in green. Small caps and anything below bottom line here, sorry about that, the sneak preview of the next drop, means that more analysts are lowering than raising estimates. Again, that really had to do with the guidance we heard. So, US is being downgraded further, EM's being downgraded further, and this is the growth estimates on the left-hand side. So growth's coming down, earnings are coming down, really based on, elevated inflation, higher rates are starting to have a negative impact, but not enough to push us into a recession yet. You can definitely see the impact in the guidance from companies. A little bit weaker guidance from corporates out there, but again, still healthy based on historical balance sheets. So turning to fixed income land, we'll start the yield curve, which is the base price for all fixed income instruments. So everything prices off of this. And when we talk about the yield curve, all we're looking at is different income streams from different maturity dates. So when we look at the current one, which is 730, which is a salmon color, so a 6-month lending to the government, I can get 2.9. If I went out for 5 years, I get 2.7. If I loan out government money for 30 years, I get 3. You put those all together, you get the yield curve. So we saw the curve flatten in the month as the Fed's 75 basis point hike drove the short-term rates. So when we talk about short-term rates, really anything under here, and you can see where this really jumped up. Right? We saw that from the Fed. But with the looming recession fears, it really did weigh in the long end. So we saw the long end come down. So a curve that is flattening, which means lower short-term rates are going up faster than long-term rates, has historically been an indication that investors are expecting slower growth ahead. Because if you think about it, if I'm lending to the government for 30 years, it's much more riskier than lending to the government for 6 months. I should demand much more money from the government to lend them. When I'm not, and we see the curve flattening, is an indication of something's wrong. So again, a lot of that's called inversion. We heard a lot about that. And as you can see from this data, the 10s and 2s is just taking that 10-year minus the 2-year, which is right down here. You can see that, we have inversion. Even as expected inflation rates decline. This is not a good sign for the economy. Even depending on what we saw in the surveys and the employment market, as history shows that 86% of the time we see inversion at the 10s and 2s, we have a recession 12 to 18 months later. So we're not there yet. And we still need confirmation from that other data we looked at previously before making that recession call. And we're not there yet. The odds of a recession have certainly increased and really must be accounted for in your portfolio based on the data we're seeing. So next I want to look at credit spreads. And credit spreads adjust the price and then discharge corporations to borrow above the risk-free rate, that yield curve we just looked at, right? So this is the yield curve. And it's just the amount of income above that lenders charge companies to borrow. So if I was going to borrow it 2 years and I'm a company, I'm not going to pay 2.9 because I'm not the U.S. government. I may pay 4, 5, 6. That spread is what we're capturing here, that difference. We see banks and lenders don't see any signs of stress and are still willing to lend at attractive rates. You see throughout the 20-year average, They're willing to lend to corporates at 150 basis points over that yield curve. And right now it's at 144. And you can see that across the board that you're pretty much right at the averages. So again, not extremely cheap, not extremely expensive, but really no signs of stress like we saw in 2020 with COVID. You see a big spike up in the corporates and the high yields. And same thing, 2016 when we had the treasuries in the treasury market, you can see the big spread up. So again, we're just not seeing that yet. We are watching this really, really closely because any signs of stress in financial markets tend to show up here first because they have the most insight into corporations' balance sheets. So in terms of the rising rate environment, it's not all bad. It can be beneficial, especially to savers looking for income. With the recent rate rise, yields are starting to look a little bit more attractive. So what we're looking at here is yield to worst of different parts of the fixed income market. And you see the 10-year range is just what the income you could earn from U.S. Treasuries over the past 10 years at any given time. The highest it's ever been over the past 10 years is 3.5. Now, this is low by historical standards by any means. But again, that's the environment we've been in. You've also currently earned 50 basis points. Brings you an average of 1.4 to 2.9. You look at mortgage-backed securities, that's lending in mortgage-backed securities. You can see where now you can get income of 3.4, where average is 2.7. So again, these are not extremely high income rates, but compared to where you were before, and we look at even leveraged loans at floating rate, you were earning 6% before, now you can earn 8.8. You can see where it's starting to look a little bit more attractive, especially when you compare it to short term. Now, you also have to factor in an inflation rate of 8%, which spikes into these returns. But again, these are long-term lenders. So if inflation does end up coming down, and we think it will, the Fed will eventually do its job, make a mistake and raise rates too high, but they will get inflation down. Earning 3.7%, maybe a little bit higher, with an average inflation rate closer to 4 or 3 or 2 may not be a bad idea. So again, it's not all negative in the fixed income world. There is some positives. And again, especially when you compare it to recent history, there is definitely some positive in the fixed income market with rates being rising. So putting all this data together, we can look to our risk model, which uses a weight of the evidence approach to judge the level of risk in the financial markets we're seeing. And this really helps drive our asset allocation decisions for client portfolios. For those of us who were on the call before or know us, we use 4 lenses to view the market. Market risk. We use technical, which is made up of reversion. That's mean reversion, markets oscillate around the mean, prices go up and down, and also structure. Markets are strongest when broad. So again, that's a technical picture. Valuation, what you pay for something matters. The macro environment that drives long-term earnings by corporations, and the qualitative piece. Things that just cannot be captured in a quantitative model needs to be put in there. So as we look at the model compared to 3/31, which is the last time we met. So again, this is not as of April, this is as of March, because that's the last time we met. You're looking at these numbers, we see we're at -2. So given the 4 months since then what's happened, you can see we have a big drop off down to a -6. Really indicating an increasing level of risk in financial markets and increases the chance of weak future investment returns. When we look at the decline, we've really crossed the board as all 3 main sub-indicators, technical, valuation, macro, all show declines. Look at the technical. Overall, on the bottom here, you can see it down here, putting together the structure and the reversion. It fell by 1. It was structured due to sentiment indicators, small lots, cyclical staples improving a little bit. And that was really just due to a massive rally in July. You'd see a lot lower number if you looked at this in June. But given that we saw that massive rally in July from the small caps and the more risky parts of the market, we saw some improvement in sentiment, which rose by 1. More than offset by a drop in reversion, which was a -3. We saw structure. We saw a clear break of market support, long-term support in the marketplace since we last met. So that more than offset the small rise, and you get that decline by 1. So technical picture, looking at the overall weight of the evidence, is not supportive of taking excess risk in client portfolios. Valuation picture, which is the next one down, also weakened as we saw a dip in earnings estimates, which we saw on the previous chart we looked at, really indicating slower growth ahead for corporate profits. Doesn't mean a contraction, but definitely slower growth than before Q2 earnings seasons. And that joined that CAPE, again, was that longer term view of valuations and that dividend, returning cash to shareholders indicators that had been in the negative zone for a long time. So in like the technical picture is really indicating a more risk-adverse portfolio in asset allocation. Turning to the macro data, it's lone bright spot in otherwise dreary risk picture. We saw a small dip in copper prices, which moved into a neutral zone, but otherwise the economic data that we think matters to positive future economic activity is pointing to an attractive environment for taking on risk. The qualitative piece, Stonehearth's IC committee also has a negative outlook for risk environment, really based on that expected intentions of the Fed to keep increasing rates. So looking at the overall picture, weighted the evidence, what is our risk modeling telling us? Well, it's indicating a cautious stance in asset allocation as a poor technical picture. Elevated valuations and a hawkish Fed really does outweigh that positive influence of the macro environment. So let's take a look at how the weight of the evidence translates to portfolio allocations and what's changed since we last met. Looking at asset allocation as of July 31st, 2022 with broad asset class categories, looking at underweight, neutral, overweight. So overall, portfolio allocations are reflective of the negative risk environment we're seeing in the marketplace. You can see that by the overweight in cash and fixed income. Now, with the increase in risk, we reduced our international, both EM and developed equity exposure to underweight from neutral since we last met. Now, we maintained our U.S. equity underweight, which pushes our overall equity exposure to underweight. Since the last time we met, it was at that neutral market weight. We did maintain an overweight to fixed income, but really remained underweight to traditional fixed income, with the overweight really coming from bond substitutes, flexible income products, which are better positioned to weather an uptick in interest rates. So again, it's not that fixed income is so attractive, it's there's more opportunities with different types of fixed income to manage through the high levels of risk we're seeing in the marketplace. No surprise, you saw the risk model, you saw everything, overweight cash, given the deterioration we are seeing in our risk modeling. We also moved to underweight in our opportunistic bucket. We're finding less and less attractive dislocations in security prices that we can take advantage of. We do have some in gold, given what we're seeing. We do see some opportunities in clean energy and there, but overall we're underweight in our opportunistic bucket. So really summing up where we are, look at some final thoughts. COVID, increasing cases, but the impact is fading. Onward and upward for the Fed. Dual mandate, stable prices, full employment. We're going higher from here. I don't see how we don't. And even if when you add what the Fed is actually saying out there in conferences, I don't see how we get a pause anytime soon in the Fed raising rates. Inflation, indications of peak inflation. But like we said, and I told you, you're going to hear this if you talk to any one of us, lower inflation does not mean low inflation. Inflation can come down, but we're still going to be elevated. And we saw that in the makeup of the CPI where that could be the case. Data points to elevated inflation and maybe here longer than the market expects. Slowing economic growth, but no contraction. We still have growth. So that is a good sign from the macroeconomic data. Valuations improving, but not cheap by any means. Small pockets of opportunity in some pieces of the equity market, but again, overall, still not conducive to a bull market. Q2 earnings came in, not as bad as feared, but as we saw in the earnings estimates and the revisions, guidance was weak, and future growth estimates are definitely coming down overall for corporations. We saw that rising rates aren't all bad, right? And there are some benefits. Bonds are coming a little bit more attractive in certain pieces of the marketplace. And finally, risk environment. It weakened. No doubt about it. There's no way to hide it. The data is the data. We saw the weakening and really is pointing to an excess of risk in financial markets. And for investors, to us, what that means, caution is warranted given this type of environment. So with that, I want to thank you for joining me today. For the lawyers in the room, this is real quick, Appendix A. This is where we looked at performance. These are our compliance disclosures. Feel free to read them at your leisure. And now I'll turn it back to Amanda to see if we have any questions out there.
Hi, Chris. We do have a couple questions, but just for everybody that's on the webinar, just as a reminder to use the questions section in your GoToMeeting taskbar to enter your questions as we go through them. The first one we have is, given the level of debt, rampant inflation and hawkish Fed, how can you be so positive about the economy? Aren't you just looking at what has already happened?
Good point. I don't think I'd characterize us as extremely positive on the economic outlook. But the data is the data, right? And so far, your concerns, above while real, haven't flowed through to the economic data that, to us, matters to the future path of the economy, right? And you are correct. the majority of economic data that gets all the attention in the press, like GDP, sales, inflation, are indeed telling us a lot about what happened and may or may not be, indicative of what lies ahead. But we've done extensive research, and we use the economic data points that have historically shown to have some predictive power, right? And the future is never knowable, but you can weight the evidence. So it does have some predictive power on what lies ahead. Think about those PMI surveys I showed you, which are part of our risk model. The diffusion indices. They ask questions about the state of companies from their employees. Is conditions staying the same, getting worse, getting better? As an example, so that tells you about where it's going, not about where it's been. We also recognize the limitations of using just economic data, right? So which is why we combine it with the technical valuation and use the weight of the evidence approach for asset allocation decisions and not just rely on any one data point. So to me, it really is finding that signal through the noise. And your original premise is correct. There's a lot of noise out there. But we feel our model and all the extensive work we've done on that, is our attempt to see through that and really does capture the signal. So I hope that answers your question about how we look at the economy and how it factors into our risk modeling.
The next question I have is that you didn't mention geopolitical events in your presentation.
Mm-hmm.
I was wondering how they might affect your investment process. And I just read where China is on the verge of invading Taiwan. What happens to my portfolio if that happens? Are we prepared?
Yes, and yes, we're definitely prepared. That's a short answer. I get it. I really didn't include any geopolitical slides in this one because they're really having a minimal impact at the asset allocation level right now. But we do look at it. And if we felt the probability was high of any impacting geopolitical event out there, we would capture that in a qualitative indicator. But other than the Russian invasion of Ukraine, which is mostly priced in, but is influencing our decision to underweight overseas, it does still having an impact. There's really no high probable impacting scenario out there right now. So like you said, you mentioned China invading Taiwan, which would be hugely impactful, not only people of Taiwan and China, but really society as a whole. Yes, it definitely would hurt financial markets as well. I've heard the same rumors, you hear the talk of the news, but the fact remains that it's still a very low probability of actually happening right now. It's important to remember that you have to take into account not only the probability of the event actually happening with the impact. So again, it's just not the impact, it's also the probability of it happening. When you combine the low probability of the event with the large impact, you get some concerns, but really not enough to change your asset allocation. So it's something to be concerned about for sure, and it's a topic of frequent discussion in our IC meetings. So we are confident that we will know what to do when or if it becomes highly likely the outcome. We're just not there yet. So again, it's just not a lot going on in the world that will affect financial markets. That is knowable right now.
And Chris, it looks like we've got one more here. It says, Can the Fed deliver the soft landing of cooling inflation without causing a recession? And following up, what signs are you looking at?
Oh, man, I hope so. I really hope they can. I'm not optimistic. History, while not always repeating, does rhyme, right? And given the track record of the Fed throughout history, when raising rates, it really doesn't bode well for us, does it? We got two signals of a recession so far. The 2 quarters of the road of GDP. Again, doesn't mean it's a recession, but it's a signal of one. And we did see we had the inverted yield curve. And I would expect to see more as the Fed continues. We're just not there yet. So we're continuing to watch that data for clearer signs of recession at hand. So stay tuned. I think there's one on the horizon. And I think you also said, what signs you're looking at, Amanda, on there. Well, we don't look at any one sign, right? Again, we look at the total. So what happens in entirety when we're looking at the data, right? So a month from now, it's just not one data point moving. There's a whole bunch of different data points moving, and how they all interact with each other is going to go a long way in determining our model. But if you really want to get an idea about what data is kind of scaring us right now, and they really want to see, I really look at the credit spreads, right? We saw in the credit spreads going back here, right here, is I'm really watching this. So if we see any signs of these really expanding here, not seeing it yet, that would give us pause. I think the other parts of the yield curve, if they started inverting, like we saw 10s and 2s, you have 10s and 3s, which is just something similar, just taking a 10-year against a 3-month. and it's close to inverting, if that happens, those are two really important data points. So again, not any one data point, but those two things that I really look at that fixed income market to be giving you indications if a recession is getting closer and closer, and looking at those spreads and any more parts of the yield curve invert.
I think that's all we have today. Just as a reminder to everyone, if you want to head back to this presentation to reference it at any time, we're going to have that uploaded on our website at www.stonehearthcapital.com, and we'll have that up shortly. Chris, thank you so much for all this information and joining us today. And just as a reminder to everyone, you can go ahead and sign up for October, which will be the next CIO's Corner webinar. The link is already also up on our website, so you can find it there. So thank you all so much for joining us today, and thank you, Chris.
Thank you, Amanda, and thank you all for joining us. Have a great day.
All right, have a great day. Bye.